All right, let's talk about Caleres. You know them, they're the parent company of Famous Footwear and Sam Edelman. Well, they just dropped their Q3 earnings, and whoa, the numbers really sent some shockwaves through the market. See, they're in the middle of this massive strategic shift, and this report, it's got everyone asking some pretty serious questions about just how much that pivot is going to cost. So let's break it all down. And here's the immediate verdict from the market. A brutal, almost 21% plunge right at the open. You know, this wasn't just some small pullback, no way. This was a massive signal that investors are seriously rethinking the whole story here. So what on earth was in that report to cause a reaction like that?
Okay, so what we've got here is a classic head fake. You look at the top line, the revenue, and you think, hey, this looks pretty good. They actually beat expectations. But once you look under the hood, the whole profitability picture was just collapsing. And to make matters worse, they completely slashed their guidance for the future. So, of course, that triggered a massive sell-off.
And this, right here, is the absolute core of the problem. Adjusted earnings per share. It came in at just 38 cents. Now, you got to remember, Wall Street was looking for something around 80 cents. So this isn't just a miss, it's less than half of what everyone was expecting. And a gap that wide? That's a massive flashing red flag for investors.
And this is where things get really interesting, because you can see that disconnect I was talking about. Look at the revenue. It beat expectations, up over 6% from last year. Nice, right? But then you look at the gross margin. It got squeezed by 140 basis points. What that tells you is, yeah, they sold a lot of shoes, but they didn't make nearly as much money on each sale as they were supposed to. Profitability just wasn't there.
So the big question is, why did profitability fall off a cliff like that? Well, it wasn't just one thing. It was really a perfect storm of two major issues hitting at the same time. First, you've got those ongoing tariff pressures on anything they're sourcing from China. And second, there are some really heavy costs tied to a big new acquisition they're trying to integrate.
And this right here really illustrates the strategic shift that's at the very heart of what Caleres is trying to do. Their brand portfolio, we're talking Sam Edelman and the big new one, Stuart Weitzman, it's now almost half of their total sales. Now, this is supposed to be the higher growth, higher margin part of the business. It is the future of the company. The problem is, making that transition is proving to be incredibly painful and expensive right now.
Okay, let's put all the pieces together. The Stuart Weitzman deal alone was a huge drag on earnings. I mean, it took what would have been a 67-cent EPS and knocked it all the way down to the 38 cents they actually reported. Then you pile on the tariffs hitting their margins and the fact that their core Famous Footwear business was actually down a bit, and boom, look at that operating margin. It just collapses from 8% a year ago all the way down to a measly 1.5%.
So in the face of all this bad news, management isn't just hiding under a rock. They're coming out with a very specific story. They're framing this whole quarter not as a failure, but as a deliberate, and yes, very painful, pivot. The narrative they're trying to sell to Wall Street is, hey, we know this hurts now, but we're taking our medicine today for a much bigger payoff tomorrow.
And to back that story up, they've laid out a pretty clear three-step playbook. Step 1, get sourcing out of China, and fast. They want to cut that exposure to less than 10% by the end of next year. Step 2, find $15 million in cost savings. And step 3, this is the big one. Get that new Stuart Weitzman acquisition to stop losing money and break even by 2026. A very clear set of goals.
And really, this quote from the CEO, Jay Schmidt, it says it all. It's the whole strategy in a nutshell. The brand portfolio is already driving more than half their profits, even though it's less than half their sales. The goal is to lean into that, to become a true multi-brand powerhouse, even if it means taking a serious hit to the numbers in the short term to get there.
But, that long-term vision comes at a very steep, immediate price. And this is why the stock got absolutely hammered. Management had to reset their guidance for the full year, and I mean they slashed it. They're now guiding to just 55 to 60 cents per share. That's a huge reduction, and it completely changes the entire financial picture for this year.
So, as you can probably guess, a move like that has really divided Wall Street. Analysts are all over the place on this one. The stock has officially become a classic battleground stock, and that's really the core debate for anyone looking to invest right now.
Yeah, we're seeing a totally split verdict from the sell side. You've got the bears, who are downgrading it to sell, saying the fundamentals are getting worse and that this whole Stuart Weitzman deal is just way too risky. Then you have the other side, the bulls, who are saying, hey, maybe this 20% sell-off is an overreaction. They see a potential deep value play here if management can actually pull off this turnaround.
So it all boils down to one key question that you, as an investor, have to ask yourself. Is this just a temporary investment year, a painful but necessary step to build a much better company for the future? Or is this the start of a much deeper structural decline? Your answer to that question is everything. It's the difference between seeing this as a bargain or a value trap.
All right, so with all that in mind, where do we land? Let's get to our take. Here's what we're expecting for the next quarter and what our official rating on the stock is right now.
Frankly, we expect the next quarterly report to be pretty ugly. The company itself is guiding for a loss. Revenue is probably going to stay soft. The real key will be what they say about that 2026 recovery plan. But for now, we think the stock is going to stay firmly in the penalty box. The market is in total show-me mode, and until management delivers some actual proof that the plan is working, the risk is definitely to the downside.
So, for all those reasons, the huge guidance cut, the major risk in getting the Stuart Weitzman deal right, and just the deeply negative market sentiment, our official call is underperform. Look, the painful pivot story management is telling, it's plausible, it could work, but the road from here to there is just way too foggy and uncertain to recommend buying this stock right now. There's just too much that has to go right.
And of course, remember, this is not financial advice.